welcome to another edition of the Pat Dale Investment Podcast. I'm Callum Newman, and we have a very big episode for you today. A little bit later, I'll be talking to Oliver Studd, a buddy of mine over in the UK, who's going to talk about his crypto project that he's building and why that's happening and how you can get involved. But before we get to Oliver, I want to tell you about a very important story, hot off the press, and it's to do with a tall building going up in Australia. Now, this is really interesting for me. I've followed these projects for a very long time. And the reason being is there's something called the skyscraper index, which is an idea behind it is that throughout history, the tallest buildings, record high buildings, have historically opened in recession. For example, the Empire State Building opened in the middle of the Great Depression in New York in 1932, I think it was. The Burj Khalifa in Dubai opened in 2009 at the height of the GFC. The towers, I think they're called the Petrobras Towers. Maybe that's wrong. Can't remember. But in Malaysia, they opened in 1998, which was the Asian financial crisis. Anyway, there's lots of examples all the way back to around 1837. So I'm always on the lookout for tall building projects. And lo and behold, we have one here. So this, let me read you a bit from the Australian Financial Review. Australia's tallest building project, 2 towers to be constructed at South Bank, overlooking the Melbourne CBD, is gaining momentum with a selection of 4 Seasons to operate an upmarket hotel in the $2.7 billion development. The hotel on the 63rd floor is expected to open its doors for its first guests by 2028. Bada boom! Now that date jumps out of me in a big way, because the property cycle I write about with Catherine Cashmore, we have the next big downturn pegged for that date as well. So that tower, if it all goes ahead, theoretically will open in a recession just like every other tall building in history, or the majority of them, I should say. So that is a very effective timing tool based off history to suggest that the property cycle, A, will keep running for another couple of years, and B, should top out according to the timing that we write about over at CT and F. So you can read about the skyscraper index. You go and Google it. You'll see all the different examples throughout it, and keep an eye out if you see any more. It doesn't have to be Australia. It's a global cycle now. So I'd expect to see more record buildings come out. And strange enough, a couple of years ago, it's quite a long time now, I'd say at least 6 years ago, there was the idea that there was going to be this massive tall building go up in Iraq, of all places. So keep your eyes out. Could be in the Middle East, could be in America, Europe. We're going to see more for sure, because these things usually become competitive as cities compete to be the world's tallest building. Just as a side note, I went to the top of the Burj Khalifa in Dubai back in, I don't know, a couple of years ago now, and it was actually kind of boring. It cost me like $150 or something to go to the top. And I made the mistake of going in the daytime, and then I got to the top, and all I could see was some buildings down below and lots of desert. Then you get out and go, oh, right, okay, yeah. Oh, I've seen it now. And they gave me a little jar of orange juice. So there's better ways to spend $150 than that, in my opinion. Anyway, keep an eye out for tall buildings. Now, the connection to Oliver. Well, his project is about the banking system and the credit they create. One of the things about this project is that it tells us that the developers think they can finance it. So they either have to raise it in the bond markets or via the banking system through loans and such. So those that assess this have to think it's viable, at least today, based off the future cash flows that it'll generate through rents, etc. So when banks make loans, the question becomes, where is that money going? Generally, here in Australia, as in the UK, we pump it into the housing market and it jacks it up with all the consequences that brings. It's not a productive use of the banking system. They should be investing in green technology, companies, things that create jobs and income. So Oliver and his colleague, who is, in my opinion, the best economist in the world, Richard Werner, are trying to build community banks that invest in productive things that creates wealth and can reinvest in the community. And they're going to use the crypto market to try and do it. So here's Oliver to tell us all about it. Alrighty, as I alluded to earlier, we've got Oliver on from over in the UK. Before we dig into the crypto project that you're building, can you study with a man called Professor Richard Werner, who in economics is an outlier but in my mind is the best economist alive today that I know of. And this, in a sense, is the background to what you're doing now. So can you just tell us a little bit about the Wernerian economic model that dominates his work and, in your view, the financial system, as it were?
Yeah, sure. So I've been working with Richard for a couple of years now across the board. I studied under him at university, and I like to call myself a Wernerian economist. So Richard invented the quantity theory of credit, originally called the quantity theory of disaggregated credit. He also coined the term quantitative easing, actually, which is now being misused by the central banks. But this theory is effectively about how banks create credit out of nothing. They create money out of nothing. And he argued this in the 90s, in the early noughties, and then in the 2014, he produced the first empirical test to disprove what the central banks were saying, that banks were financial intermediaries. And he proved that by looking at actually a balance sheet and the accounting practices of a bank when he took out a loan, he proved that money was created out of thin air. No money was transferred from one person's account to another. And therefore, the belief that banks are merely financial intermediaries and aren't important in any model was incorrect.
Just let me jump in there and say that economics teaches that banks lend deposits, or traditional economics. And most people think that when they put it in the bank, that the bank then goes and lends out those deposits. That's not what happens, is it?
Well, so financial intermediation basically treats a bank the same as any other company, and says that they're not important in any model. And if you put money into a bank, yes, they use that and they lend it out. And it's sort of like a mixture, really, is that banks are different to any other company because they're exempt from something called client money rules. At least in the UK, they're called client money rules. They don't have to segregate customer accounts to their own business account. So you can't tell the difference between, on a balance sheet, the bank's money, if you like, the liabilities, and your deposit, my deposit, etc. Whereas other firms would have to do that. And therefore, whenever they lend out a loan, they effectively lengthen the balance sheet and create an additional deposit on the liability side, which wasn't there before. Well, no one's deposited that money. That credit has just been produced. No deposit goes down on the liability side. No account is reduced. It just increases. It lengthens. And that's effectively the money creation process. And then when that money is transferred to another bank, that bank gains the deposit. So the money is still being created, even when the cash supply of the first one goes down. It still then lengthens the balance sheet overall because the deposits go up on another bank. So that's effectively how bank credit creation works. It's just financial intermediation basically says that that lengthening doesn't happen. It immediately is just lent out, and cash supply goes down, deposits doesn't go up.
And so the implications from that become huge, because where the banks are lending their money is obviously pumping new money into wherever that goes. So, and this is the great thing about Richard Werner's work. If you're somebody trying to make sense of the economy and you don't understand this point, you're never going to work out what's going on. So one of the things, and here in Australia, same in the UK, what do most banks lend to? They lend to property. So we get high property prices, and that's where you get the boom bust cycle, or part of where we get the boom bust cycle, because that is ultimately not a productive thing to create credit against, is it? So that's the feature of the boom bust cycle, and why we go up and go down all the time.
Yeah, so there's two types of credit creation. You've got unproductive credit creation, which leads to boom bust cycles, and productive credit creation, which is lending to the real economy, creating new income streams. And banks, unfortunately, they like to make money, and if regulators allow them to, or guide them into doing that, and they're more likely to lend for financial financial speculation, which is unproductive credit creation, because that can only be repaid, and the loan to be repaid, by asset prices going up, causing a bubble, capital gains, and therefore the loans repaid. However, that can't last forever. As soon as the banks stop creating that money and the tap turns off, the asset bubble bursts and you end up in a recession, which is what happened several times in the last 100 years. It just keeps repeating itself. But yeah, so Richard argues that if you instead focus on productive credit creation, which is still good, it's not a bad thing to create money out of nothing. In fact, it fuels the economy. So it's not a bad thing. It's just if you do it for the right reasons, which is lending to a real economy, lending into small businesses, then you get job growth, new income streams, you get investment in new technology, which makes things more efficient. So it's all positive things you get rather than just simply capital gains or speculation on the asset market.
Yes, and the fascinating feature of history, which Richard has talked about in his books, is that the Germans sort of set up this model and have done it very well. And then the Japanese came along later on and studied that and said, yeah, that makes sense. We'll use bank loans to build up industry. And then the other Asian tigers followed that. And that's sort of been the strength, and later China, of Asia. Now you bring your Valhalla network to the fore. So tell us, what are you trying to do with this crypto project?
Yeah, so Valhalla Network, Richard he's the chair of it, if you like. And I'm more the founder, the CEO, trying to push it forward and do the day-to-day work. What we're trying to do is set up a DAO, so a decentralized autonomous organization, that will be governed by token holders, so a decentralized governance structure. And the mission and the underlying mission of the DAO is to establish and then own community banks all across the world, starting in Europe, and then maybe in 10 years exploring other continents and trying to grow out like that. Obviously, you don't want to run before you can walk. And then effectively setting up these small local banks. Each one of these will focus on productive credit creation, lending to small businesses, which are currently underserved by the big banks, and ultimately leading to less inequality and better quality of life.
Why go through crypto? Why not establish a regular bank?
Yeah, well, we wanted to democratize the back end as well. So not only just have a decentralized banking structure, we wanted to decentralize the ownership structure as well, and allow anyone to be able to make these decisions, put a transparency across there with proposals in. That's all on chain and is easily visible. You've also got people being able to vote and kick out members of the team very easily. So I could easily be voted out by the governance token holders if they wanted to, once it's all started up. So you reduce corruption. And also it's the fact that if these banks are for the public good and they're for the community, they should also be owned by everyone in the world, really, anyone who wants to get involved and be a governance holder. So it's trying to stop people from being shut off. And that's pretty much it. It opens, by tapping into distributed ledger technology and allowing for that transparency and stuff, you open a whole new sort of possibilities for the community banking model.
And do you still have to get a banking license from the regulators to set up this bank?
Yeah, so we're not competing with banks or the banking industry as such. So a lot of crypto projects, DeFi projects, their big issue is they're trying to compete with the banks. They seem to think that by doing DeFi with stable coins, etc., that they can beat the banks and no one needs to rely on banks. But that's simply not true, because only banks can create money out of nothing. Otherwise, it's fraud. Well, it's illegal fraud. Banking is pretty much fraud anyway, because you're creating money out of nothing, but it's illegal. And that's the big difference. So by having a banking license, you are then able to take deposits, and because you're exempt from client money rules, you can then create that money out of nothing and lend it out. In DeFi, you can't create out of nothing. You can lend out. So we're combining the two. We're combining the ethos of blockchain and distributed ledger technology of transparency and decentralization and less corruption with the banking system, which is so powerful because of the banking licenses they have.
Don't you need, as a bank, crazy amounts of capital? Isn't that the thing that always blocks startup banks? Is that they need like 50 million plus just to start before they've even done anything?
Well, it depends on the depends on the jurisdiction. Not quite that much. I don't know anywhere where they require 50 million. For example, our phase one bank, so there's two phases to our project on the banking side anyway, is to set up a for-profit phase one bank. Now, this is to allow the DAO to survive the early years, to support the DAO and the governance token holders in the early years by generating very high and sustainable cash flows that go into the DAO. While that's happening and those cash flows are being generated by the phase one specialist bank, the phase two starts of setting up all these community banks that are not for profit, but they're still profitable, but they act not for profit. They act in the interest of the community, serving the clients rather than serving the shareholders. So they take about 4 to 5 years to become profitable. So while they're being ramped up and becoming profitable, you've got the phase one bank. The phase one bank we're starting with, well, we're approaching the regulators with 20 million, but we will be starting it with 75 million. But that's not the legal minimum. We can start up a bank with 20 million, In the UK, you can start up a bank with sort of 10 million and you'll be okay. It's just, yeah, that's still a lot of money, and it still means that, it's difficult barrier to entry. The big thing as well is how quick the regulators deal with you. If you approach them with 10 million or the bare minimum, like 4 million or something, which is like Lithuania, they're more likely to take a while to deal with you. They're not as interested. You're not as a big fish. You're not as serious. But if you approach them with 20 million, the regulators look at you and say, okay, well, they're serious about it. They're able to have more of an impact, so we can look at them quicker. So that's really the barrier to entry, but it's not quite 50 million.
I did pull that figure out of nowhere a little bit, but I knew it was a lot of money. It's just, it does seem crazy ambitious what you're trying to do, because not only do you have to establish a bank, then you've got to find, like, you've got to get your brand or your marketing out there to find customers. Once you've got your license, and then I guess you go to what, the debt markets to like finance your loans down the track. Like, it is a very complicated project you're going for here.
Yeah, well, we've got experience of setting up banks already in the UK. We've gone through the regulatory process, and in the UK, the regulators are much more stringent than other areas. They're much more tough to deal with. So, the fact that we've gone through that process has set us up nicely for this challenge, if you like, for this mission. It certainly is a big sort of, we're aiming for the stars, and if we hit the moon, fantastic, sort of approach. If we can set up and have 10 banks in the network in 6 years, that would still be a massive achievement to have. Now, obviously, we would want more eventually and to ramp that up, but these things take time. You can't build a network like the Sparkassen, which is the German community bank model and network. You can't build that up in 10 years. It takes a long time, and you don't want to make any mistakes and end up paying out loads of money and not getting much of an impact from it. However, the good part about it is you don't burn much cash when you set up a bank. By much, I mean you still burn millions, but you're not burning 20 million. So we're starting the first bank, the Series A anyway, and then Series B. We will be approaching the regulators with 20 million, but that 20 million isn't being spent. It's there as bank equity, because you need to have it there so regulators see that the bank can start up with this tier 1 capital, which is a regulatory capital that the bank has to have. And therefore it's available to even go through the process. If you don't have that capital, regulators won't even look at you. So you can't start the bank license application process. However, you're only burning about 2 million, 2.5 million, actually to set up set up the entity, set up the IT, get skeleton staff in, go through the fees, go through auditing, legal fees, etc., etc. So you're only burning about 10 to 20% of the total amount that you raise, which means that if this massive mission of ours, for some reason, it doesn't, in 2 years it hasn't worked out or something like that, we've still got 80% that we can then return to the investors. So it's quite it's a huge mission that we're setting out for, but it's relatively, compared to other crypto projects, it's relatively low risk because we're not burning capital.
So when you talk about, so you've raised this money through the crypto world.
Yeah.
Who is it? Is it like wealthy individuals? Is it institutions? Where did you find people willing to invest in this project? Because it's a long lead time. Remembering that the guy that released, what is it, Dogecoin or whatever, did nothing but put the picture of a dog on it, and it went bananas. Like, how did you get in front of these people?
Yeah, so well, right now the main investors aren't just crypto enthusiasts. They've been big fans of Richard Werner and his work, and fans of Local First and what we're doing in the UK, and people who want actually to make a difference. They want to bring forward this ethical community banking approach that serves the community, isn't acting in the interest of the shareholders only, but actually interested in the customer. So it's people like that. You've got private individuals who are wealthy. We've also got a fund interested at the moment we're going through the process with them. And again, they want to make a difference, have an impact. It's not just about making absolutely massive returns, because this is a governance token. It's not a security. It's something that gives you the rights, or it doesn't give you legal rights, but because of how the DAO functions and how every DAO functions, governance token holders will be responsible for governing it, managing the treasury, managing what you do with the money that comes in from all the banks and dividends. So, it's an interesting part, but there's no security element there. It's not, the investor shouldn't have that.
I assume that when they bought in, they would get a token that was like, would eventually, the dividends would flow for, there would be an equity stake. So you're saying this just gives them the right to be like on the board as such?
It's a governance. We have to be careful here because of regulations, but it's not a security. So there can't be an expectation of profit. However, a governance token holder, out of any DAO, you're responsible for managing the treasury, managing what the DAO does, where it sets up these banks, who's involved in it, who's running it, who's involved in market. You can pretty much, you're governing everything. If you vote something and it passes by the governance token holders, then it happens. Think of it as like a sovereign state, whereby by being a token holder, you are like a citizen. It gives you, rights to then vote on things and manage the state that's there.
Doesn't the complication come though that if, just say, you think as CEO that you should set up a bank in Bath, for example, in the UK, and then you've got all these people that have perhaps disparate
different views
and things, and then suddenly it turns into this dog's breakfast of like, you can't get any motion through.
Oh no, so there's always going to be some sort of majority vote. At the end of the day, the people who are owning the governance token holders want it to be successful. They want to see these community banks start up. So unless it's a really bad proposal and there's no reason why a community bank should start there, I wouldn't think anyone would purposely vote no against, vote against it, and try to stall the project and stop it from going ahead. So
I'm assuming most of those people will be, in a sense, passive. That they're willing to invest in the project, and they'll just sort of, as you say yes to whatever you think is best for the network.
Well, they'll vote on what they believe is best, and that's the key part. Is it removes the corruption element, because with power comes responsibility, and a lot of people with power end up being corrupt. So by having a DAO, a decentralized vehicle, a decentralized company, if you like, a foundation, it removes that corruption element because it's all on chain. Everyone can see what decisions are being made. Everyone can see who's voting on what proposal has gone in. So if a proposal goes in and gets voted on, it passes, and then it doesn't get executed, that's a massive red flag. Everyone can see that that's happened. Everyone will be complaining about it. That will effectively bring the project to a standstill. So you don't want to do that. So you want to act in the best interest of the governance token holders at all times. You want to do what they tell you to do, because if you don't, the project won't be successful. So it's everyone is an owner, if you like, of the DAO, just not in a legal security sense. You're just everyone is in it together.
I know I believe that one of Richard Werner's concerns is that the central banks are going to release central bank digital currencies.
Mm-hmm.
And as part of that, they will essentially wipe out the private banking sector. Is that a risk to any bank, community bank, big bank, that can happen?
Yeah, it is. CBDCs are, they're coming, or it looks like they're coming anyway. As with any regulation or any big thing like this, it's going to take many years to come through. And the bank should be standing up against it. And I think they will. I think they'll come to realize that this is a massive risk to the sector and to people's, sovereign rights and people's liberties. However, do I think it's going to wipe out the banking sector? No, because one, at the moment, they're looking, depending on which CBDC you look at, but some of them are a hybrid approach where it still goes through the banking system. So the banks still take deposits. Others are looking at more of a centralized sovereign style bank, which will destroy the banking sector. It will lead to mass unemployment, mass insolvencies and bankruptcies of companies. So, if CBDCs are coming, it's a risk to everyone, and it's a risk to every industry. It's not just the banking system. So, I think it's going to be a while for them to come out. If they do come out, I think there'll be a big backlash, and hopefully all the banks will stand up and say, no, this is wrong. However, that's more likely to happen if you've got a decentralized banking system with many small banks that then are engaged with the community, speaking to the community. Everyone's more aware of what's happening. And then you've got many people standing up and saying no, rather than just trying to control and manipulate a few big banks where the CEOs can be, bought off maybe, or something like that, where there's more chance of some sort of corruption. If you've got many banks, it's harder to have that corruption.
I know another big thing for Richard Werner is that low interest rates are put out as a benefit for the community, as it were, or a stimulus for the economy at least. And he says, no, that's not true, because it hurts banks and it hurts their profitability and therefore their credit creation. It should be the other way.
Yes.
Can you now I believe as what happens in that situation is banks, where they can make money is in mortgages. It's more profitable than business loans. So they do a bias towards that sort of speculation, which we were talking about before. Is that going to be problematic if these interest rates continue to stay so low? For
Well, it looks
a
at the moment,
community-minded bank.
yeah. So at the moment, it looks like the interest rates are going back up anyway, or sliding back up gradually. Yes, interest rates being low is a problem for a community bank. For any bank, it's a problem. It doesn't mean you're not going to be profitable. It just means that you might not be as profitable, or it might just mean that you have to pass on slightly higher rates to your customers, and the spread, you have to control that spread because a bank has to be profitable. So the bank itself, although yes, it will struggle a little bit, it will still survive. It's just, it will mean that customers are affected, and you can't do as much productive credit creation like you said. And actually, low interest rates don't stimulate growth. They don't stimulate the economy. It's nothing to do with interest rates, actually, the economy. In fact, Richard's proven by looking at it, and I was talking to our CFO, actually, Borja, today, the CFO of Valhalla Network, about predicting yield of a 10-year bond based on nominal GDP. And what he's found is that, like Richard says about interest rates actually lag growth, is that there's a strong correlation between the 10-year nominal GDP growth and the 10-year Treasury security yield, which means that actually the interest rate isn't affecting growth at all. It's the other way around, that if you have growth, the interest rates go up. If you have less growth, interest rates end up coming down.
Yes, it's so funny because it's such the opposite of what everybody says. And that's one of the great things about the body of work that Richard Werner has put together. It's just like, you just do all these head slaps and you're like, how is it that the mainstream will tell you one thing and the complete opposite is true according to the evidence? And all that.
Well, he was doing that throughout the 90s as well, like in Japan. It's quite a funny table, actually, he showed me once in the Profit Research Center, was when he was saying one thing and the narrative was this, the mainstream narrative was this, and the result was always what Richard was saying. And it was like that throughout the 90s in Japan. He said something, it was against the mainstream narrative, and he was right. And it tends to be how it is. And that's why it took so long. And in the end, in 2014, he had to do that empirical test to say, actually, look, I know I'm right. I'm going to prove it. And when he proved it, then all the central banks started to say, oh, banks actually create credit out of nothing. We know that. And, that's just coming to light now. We weren't trying to lie before. It's just, we now know it. But yeah, Richard had to prove it, and by doing an actual empirical test, because they like to.
He, as brilliant as he is, there have been other writers and academics throughout history who have said this, that the banks create credit out of nothing, but there was this other factors that said no, this is how it works over here, and that type of thing. So once he sort of points out his work, he sort of leads the way. You can go back and see, actually, there were lots of economists that pointed out this, but he's sort of put it all together in a very unique framework for not only the banking system, but for what it means for the economy as well.
Well, that's the big difference, is that many economists said banks create credit or create money, but they didn't know how it impacted the macro environment, how it impacted the wider economy. Richard has put that together in his quantity theory of credit by saying they create money, and how it's used, what it's created for, has an impact on the economy. And by actually looking at this credit creation process, you can predict what market's going to do, whether you're going to have an asset bubble, whether it's going to burst. And he put all that together in his theory. So yes, economists have said it before, but it's actually been Richard who's come together and put it together as one sort of complete theory.
Absolutely. Just to swing back to the Valhalla Network. So when you talk about that token, that's not something we can yet go to Coinbase.com and see trading, right? Like it's in the private hands of those investors.
So the token doesn't actually exist yet. It won't be minted until we go public. At the moment, we're in our Series A raise. We're in the last sort of 30 to 40% of our Series A raise, coming along quite nicely. So at the moment, it's people contacting me saying, look, I want to invest. This is how much I'm interested in, and then signing a simple agreement for future tokens. And then these contracts protect the investor. And when we mint the token in about a year's time, when we do the token generation event, that's when we go public, and all the investors who have those SAFs, who have paid and they've got a discount on the token, because we give them a discount for investing now,
Yep.
they then get all those tokens that they bought at discount sent to their wallets, and then the other tokens that are minted and then sold to the public. And that's when you then do like a launch pool, or you put it on a centralized exchange or something like that, which is where you could then go up and buy it.
So those government tokens, they will be tradable when they go live? Is that what?
Yeah. Yeah. So when it goes public, they're then tradable. So anyone can buy and sell. The investors can't. The private investors can't, because they're vested.
They're not equity in the company, but the token could still appreciate if the crypto investor or the crypto market wants to drive the price of that thing up.
Well, I've got to be careful because it's not.
I know you don't want to call it security.
and I can't put any expectation of profit across to anyone, because then I'd be putting, so I've got to be clear that I can't, there's no expectation of profit. However, yes, the market might do it. People might see a demand for this. They might say that the staking rewards that are there, starting with 5%, then in phase 2 going to 12.5%, but that's very attractive, and they want to get in on that. And they like the participating in the DAO and deciding where community banks are set up and what we do with the funds that come in. They might like that aspect. So therefore, the price, yes, it might appreciate over time.
It might go down too, right? Like you got to take one.
Yeah, it could go down. And the mechanism we have is when we pay out these staking rewards in the token. So let's say you own 500 governance tokens, 500 Valhalla Network tokens, and it's a 12.5% return. So about 60 tokens, let's say. So you get 60 tokens. The foundation, the DAO, will then buy 60 tokens back from the market with the cash that is received from the dividends that come in from banks. So we're controlling the supply like that. So just because we're giving staking rewards out, the supply won't be going up, because then the foundation is buying them back at the same time. But yeah, so people might like that and see, a consistent interest rate, if you like, staking rate, and they might like that.
So one of the nice things about this is, like, in the crypto world, we, joked a little bit about Dogecoin or whatever it is and the stupidity of that thing going bananas. Mm-hmm. This is like a real project and a real productive way of using this new industry to create something of what could be really cool, right?
Oh yeah, certainly, because then this can't be bought out. So this is another reason why a DAO is so important, and a good way to do it. This can't be bought out easily. Well, it can't really be, because you'd have to buy it from everyone who has a governance token and buy it off them and try to accumulate more and more. However, because of our voting, the formula for voting, the more tokens you have, the lower impact more tokens have on your voting power. So even if you accumulate loads of them, you don't have all the votes. So it's very difficult to take over and control and then try to abuse for your own benefit and shut it all down effectively. But yeah, this is the sort of first protocol of its kind, or at least that I know of, that has, there's a couple out there which has some real world impact, but this is certainly the first on the financial sector that really has some real world impact. Plus, it's not supported by hype. At least, the hype comes fine. The price of the token does whatever it wants when hype's there. And most protocols in the crypto space, they're pretty much supported by hype alone and just people just wanting to speculate and buy into it. Our project is actually supported and backed by real world cash flows, because it's a real world business model. It's generating returns. The DAO owns the shares in the banks. The DAO owns securities. The DAO is entitled to those returns that the bank makes, and therefore the project is supported by those real world cash flows.
So anyone listening to this, how can they follow? You said that obviously it's not trading publicly yet. So how can they follow what you're doing, and if they want to be involved, how can they get involved or think about getting involved?
So the first point of call, I'd say go to our website, which is valhallanetwork.io. And that has the white paper on there, has all the team and advisor information on there. We've got some really great advisors on board. Obviously, Richard's in the team, and he's sort of the most important person and biggest character involved. But the advisory board is really second to none. It's fantastic. So I'd say go there to start with, and read through the white paper and see what we're up to. And then the second point of call would be Twitter, which is Valhalla DAO. So Valhalla DAO and then _. And we've got at the moment about 350 followers, so not a huge following at the moment. And if anyone has any questions or wants to get in touch, they're more than welcome to then contact me by trying to find out my details, which is on my website actually, so it's not too difficult.
Don't make it difficult.
It was originally, and then someone pointed out that wasn't actually on there, my email, so I chucked that out there to make it slightly easier for people to get in touch if they wanted.
So you're a busy man. So obviously you've got this, which is like huge amounts of work, but you're also building towards putting that credit creation model of Richard Werner into an actionable thing for investors too, which is separate to the Valhalla Network. Do you want to touch a little bit about that as well?
Sorry, just to clarify, are you talking about local first?
I was talking about Profit Research Center.
Oh, sorry. I was really confused. Yes. So that's a project that's still ongoing. Really keen to start that up. We decided that we might change the name from Profit Research Center to Werner Economics to make it more sort of personable and friendly to the retail. In fact, we spoke about that before. Richard's original PRC, Profit Research Center, was aimed at institutional investors. Investors like Peter Thiel were buying his research, and very different scene, very different marketing, and directed towards different people. So we're now starting up this retail financial advisory firm, which we are going to call Werner Economics, and it will offer effectively this package that institutional hedge funds and etc. used to buy at a much cheaper rate, much more affordable rate. They'll also have Richard doing sort of weekly podcasts, short podcasts where he gives his opinion on different areas of the market, what's going on, what he thinks the market's doing, and also some sort of seminars and conferences that we'll eventually put on as well. So that should be coming as well in the next couple of months. But it's quite full time, like you said, at the moment, especially going for a fundraise. It's always full time when you go for a fundraise.
Absolutely, yeah. No, I'm excited for both projects actually, and if you're listening to this, just from my view, Richard Werner is one of the few people worth listening to in financial markets. And as I said, I've got all these books here. I've read all these books, and so I'm thrilled to see what could happen there. All right, so we've summed up what you're doing with Valhalla and where you might go down the thing. So if you're listening and you're interested, definitely start following this project. It's a good way to get into crypto too, actually, because it shows you why. Because crypto is criticized by many people for being this fluffy thing that they don't understand. It's speculation, But it does show to me, I think, where this new asset class can take new industries and remold them and reshape them and do something even better than what's out there now. So it's really cool. So thanks for coming on, mate. And
no worries.
As you progress, let's keep updating the story and like especially when you come up to the, what did you call it? The token generation event. That sounds very cool. And see where the project is then.
Awesome. I would say, if anyone isn't involved in crypto, always be a little bit wary because, in fact, quite a few investors that we've got coming in haven't been involved in crypto at all. They want to see it come to fruition just because it's still, the team are in control in the early phase. We've decided to go through a sort of fully regulated bank governance structure. So, for example, we have a separate independent committee that will decide on all the salaries, etc. So we're not.
Are you the head of that committee?
No. Oh, Richard is, and then we've got two independent advisors, and then none of us vote on our own sort of contract, etc. So it's all quite a bank sort of orientated governance structure. Many protocols don't have that, and you hear of things called rug pulls, which give crypto a bad name. But the actual distributed ledger technology, what it enables is beautiful, really, and it's a fantastic thing. It's just been in other protocols, it's not always been used for good, and just be wary of that. Is that there's some protocols out there which you certainly need to be looking carefully at.
Absolutely. And I think this is probably the strength of your project, that you have a man of Richard Werner's credibility. He's not going to be involved in anything that's dicey. So that's a massive asset for you. All right, mate. Thank you for coming on. And awesome. As I said earlier, we'll follow up with you in about 6 months.
Yeah, awesome, Callum. Cheers for that. Take care.